Welcome to the Pot.Live podcast. I'm your host, Len and Mark. This podcast is all about connecting the community with the thought leaders of business and entertainment in the cannabis industry. As this industry expands and becomes more and more mainstream, we want to educate and entertain our listeners and become your choice and voice for all things cannabis. Thanks for joining us and enjoy the show. Have you visited MJ.com? MJ.com is the online destination where you can find everything you need to know about the emerging legal marijuana industry. Where else can you find the latest original content, news, and trends? Connect to a local doctor to obtain your medical marijuana card, receive exclusive brand savings, and have your favorite product delivered straight to your front door? MJ.com has it all. Go check them out. Welcome to another episode of the Pot.Live podcast. I'm your host, Lenny G, and today we have a unique and special guest, my friend, Mr. Mark Yegge. He is a hedge fund manager. He is the founder of hackingmoney.com, and we are going to go over some technical analysis of some of the pot stocks, if you will, that maybe you all heard of or maybe you haven't heard of. For the investor out there who's thinking during this pandemic that we're recording this in, all of a sudden pot stocks are popping a little bit. They had a roller coaster ride the last few years. We're going to dive into that. Mark, welcome to the show.
Thanks, Lenny G. It's great to be here. It's great to be here talking with your listeners about this very interesting and dynamic space.
Yeah, I mean, I appreciate you, an expert, somebody with your experience in technical analysis. I think it'll definitely be fascinating and refreshing. So let's dive right in. Why don't you tell everybody a little bit about your background, how you got involved in hedge fund management and just analyzing stocks of all sectors?
Well, to not bore the people that are listening to this podcast, I won't spend too much time, but I have been investing since I was 12, which gives me, crazy enough, over 40 years of investment experiences in various different things. I invested all through high school, college, after college, had my own Wall Street companies and all the licenses. Bottom line is it's nice to run a hedge fund for some people that really care, and I care about them, and we like to get some good returns. So bottom line is I have an aggressive hedge fund. I also have an income-based hedge fund that we're launching now. And, part of what I do is I do techno-fundamentalism, which is I analyze things from a fundamental perspective, which means, what the company does and who the owners are and the management and all that kind of stuff. And then I look at charts, and charts really are emotions on parade, essentially. You can kind of tell what the emotions are on stocks just by reading their charts and looking at the price and volume action. And that's been true for basically thousands of years, but certainly hundreds of years since we've been charting modern stock market performance. And so human behavior doesn't change over time. The stocks may change, the names may change, but the action and the technicals generally tell a very compelling story. And then it all leads to the way I trade, the way I invest, which is all about probabilities.
Got it. Okay. So now for the layperson out there, and on a lot of my episodes, I tell the guest that we have all different listener types. We have beginners to the cannabis industry who are just, following the momentum of hearing it on the news, seeing it on social media, and they just want to learn more about it. We have the business owner who's trying to scale their company. We have the private and or public executive that are listening and trying to learn about what to do for their own business. But this one's going to be geared towards the average or maybe seasoned investor. So let's, pick one of the stocks in the cannabis niche, since that's what this show's about, that maybe some people have heard of or that you've been following, and tell us a little bit about the last few years of the run up, the crazy valuation, and then the steep decline as some of those valuations were unable to be met with revenue and profits, and where we are now.
Okay. And I'll just basically tell the story from the charting perspective, because certainly your listeners and you probably have way more fundamental experience in this business than I. So, and I don't know the business as well, but I can certainly tell you what the charts are telling me. And again, this is all a probability business, because let's just go back to that real quick concept, then I'll launch into a stock. When one person buys a stock, that means when somebody else is selling it. So one person believes it's going to go up and one person believes it's going to go down. Not everybody's going to be right. So you have to figure out ways to stack the probabilities in your favor. You still may not be right, but you could inch them up from 50 to 60 to maybe 70% if you start to look at certain things, and charting is certainly one of them. So I'll start off with just kind of a description of what I consider and what I've been able to see is, as a public company, the Cadillac of your cannabis stocks, and that's Canopy Growth Corp. It's a Canadian-based company that sells marijuana, manufactures it, and they do it for recreational and medical. Not everybody is in both those niches, it seems. There was a big operation going on in this market, big excitement that happened September of 18. There was a huge run-up, and things plateaued, and everybody was talking about pot stocks. My phone was ringing, every single day, twice, 3 times a day, asking what pot stock should I buy. So Canopy Growth was one of those stories. And I know fundamentally one of the things that's going on with Canopy is they've got big investment from Constellation Brands, which is a major player in the beverage business. And they're looking at doing some things with cannabis, in beverages and other things. So they put up several $1 billion behind this company. You know what? It didn't matter. The stock has plummeted even since that investment. And when I say plummeted, I'm talking about the stock that went from a peak of around $60 a couple of years ago to went below $10. So if you had owned that, it was a very painful time if you didn't have a strategy to get yourself out of that. If you were one of those people that said, don't worry, it'll come back, like we all do, you'd really been sticking around for a 2-year period where you still have most of your money gone. Now, on the other side of that, about 2.5 months ago, at the bottom of this coronavirus deal that we went through at the end of February, let's call it, we had a big spike up. So if you had happened to be able to pick the bottom, and I don't ever recommend picking the bottoms, I'm a trend trader to try to pick the tops and the trends that are breaking out. But if you were one of those people that said, oh, I think $10 is a bottom or $9.50 is a bottom, you'd have been very well rewarded. You would have been doing what's called catching a falling knife, the knife that's going from 60 to 50 to 40 to 30 to 20, under 10, and not knowing if it's going to stop at 10 or go down to 0. But if you had been able to pick the bottom, and actually today you're looking at a stock that's at $16, you'd have been up 60, 70% in that stock. So the overall trend of that is not unlike any of the other companies in the business. It's all trending down. However, they're all bouncing. Okay. Now, how long these bounces last, I don't know. But cannabis, to me, if I were going to invest in any one of the ones that we may talk about today, cannabis would be the one because they have a major player that's backing them up with billions of dollars, and that major player does not want to see them fail.
Yes, I agree. With Constellation having such a large stake of Canopy, you would think just what you said, that they will not allow them to fail, where some of the others, so Canopy, you just said, went from about 60 of a high down to 10 of a low ballpark.
Yep.
There were some other ones that ran up almost like the internet boom stocks of 20 years ago, where they ran into triple digits and then went down into single digits, right? So before we jump into those, can you just talk about the investor emotions of when an average novice investor goes on their iPhone and looks at their stock chart for the last couple of years and they say, oh, this stock was at 80 or 100, now it's 10, it must be a good buy. It's got to bounce back at some point. It's got to do something, but really they should be analyzing it at the price it is now and what it can do from here, correct? Can you talk about that a little bit?
Yeah, I love to talk about that because the stock market is unlike any other marketplace that you're ever involved in. You never go to a grocery store and want to pay the best possible price, the most possible that you can for a piece of clothing or for something like that. You want to wait and buy it on sale because it's a piece of clothing. If it's worth $150 today and they put it on sale half off, you got a great deal, right? So you feel like you got a great deal. Doesn't really work like that in the stock market because the stock market is supply and demand driven. So who drives the supply and demand? It's the big institutions. And so when they're selling, you don't want to be buying. When they're buying, you don't want to be selling. You want to ride their trend because they move the markets with supply and demand. The stock market is an interesting game because we have this thing, it's almost the opposite of the way we're wired, right? We first of all, we don't want to be wrong. We say, let's say that you're a person that does a ton of research. You know this company, you know the owners of it, you know how much money they got as an investment, and you know when they went public and whatever, you know everything about it. You feel like you're a part of this company. So certainly you don't want to buy it and have it go against you. But that happens 50% of the time or more, right? So you buy it, and then it goes against you. Now you have a choice. You either admit you're wrong, and that's very hard as humans to do, especially when you've got so much mental energy invested in buying something, or you say, you know what, I was wrong. Let's move on and go on to the next thing, and I can always buy it later, right? When it shows me some strength or shows me some reason to buy it again, because you were already wrong. most people do is they say, don't worry, it'll come back. I'm not wrong. And so if you buy a $10 stock, let's call it a $100 stock. And if it goes down to 93, let's say it goes down 7%, in order to get it back to 100, it only needs to go up about 8%. But if a stock goes down 50%, and this Canopy stock and some of the other ones we'll talk about have gone down way more than 50%. But if it goes down 50%, now it's got to double. It's got to go up 100%. And there ain't a lot of stocks that go up 100% that you can rely on. So we're fighting that urge. It's like, I don't want to look wrong. So when it goes down, you know what? I loved it at 100. I'm going to really love it at 93. So I'll buy more. Big mistake. Because you're doing is you're just amplifying, magnifying a bad decision. You're making it worse. You should be averaging stocks on the way up into strength as the institutions are proving them to be right, as you're being proved to be right, not the other way around. So that's the major overriding theme on buying stuff and trying to average down when it's going down. It just doesn't work most of the time. And that's what really tanks most investors' portfolios.
Yeah, I think people do the opposite, right? So if they buy a stock at 10 and it goes to 20, that's showing great strength. They don't buy anymore because they think it's going to ruin their profit or their gain, right? Because if they just buy the same amount at 20, that's really didn't make any money yet. They're cutting their gain in half in their head, but really they should be buying a stock that's doing well like that because that stock has more of a chance to go to 30 than the opposite, the one that went from 20 to 10 has of going back to 20. Would you agree with that?
You're 100% right. And people have heard the saying that you never go broke taking a profit. And so what people will do is they'll book the profit at 20 and then they'll say, well, I'm just playing with house money. But you don't get rich that way, right? You might be able to make a profit, but if you don't have a strategy on the downside to protect the losses, you're going to get eaten up on the next one that goes down from 10 to 5, right? So you've got to have a strategy that if it goes up, you may not buy the same amount. You may buy less on the way up and average up, but less, keep your average price fairly low so that you don't lose money. But to be pulling profit off the table doesn't mean that you're going to be able to catch those Amazons, those Microsofts, those Ciscos, those big, 1,000, 2,000, 20,000 percentage point gainers over time. And those are the life-changing stocks. So if you find a stock and it's trending, you want to keep staying on the side of that trend, but adding at the proper points on that trend as you build a position that really means something in your life, not just taking profits short term, because that's not a trading strategy.
Got it. Okay, so I know you have a few stocks you want to hit on, but I'm going to jump the gun because we've been talking about one stock that's been in the news this week when we're recording this in May of 2020, and one that you and I have talked off the air about, and that's Aurora. Aurora was up, I think it was it over 100? I think it might have been over 100 at one time, or you can correct me if I'm wrong.
Like 150, I think it got up to.
Yeah, and then it went down to under $1, and they were about to get delisted, and they did a reverse split, 12 for 1. So if you own 12 shares, you're only going to have one now, and then that's usually a death sentence for any stock, pretty much. Why don't you tell us about the chart from the run-up down to the reverse split and what happened in the last few weeks with Aurora and why, and I know I'm giving you a lot here, and then I want to discuss what we just discussed, that fear of missing out we talked about, that ride up, and now people are jumping in too late or too early. I want to go, this is a great stock to go over all those things with because it's had such a unique ride.
Boy, it sure is. Yeah, so this stock, I'm only showing the post-reverse split chart. So I can tell you that before the split, the stock went over 1,000 if you're talking about a 12 for 1 reverse split. But my chart shows that it's 150 was at the peak, and at the low it was around, I don't know, let's call it $6. And so I guess in your, what you were just saying is it would be, probably went down to about 50 cents. On a 12 for 1 reverse. Yeah, anyway, all they do is they create fewer shares and try to amplify the stock price. But it's quite a rundown the stock had. It was almost just like falling off a cliff. It's like one of those double black diamonds you ski down, right? And so this thing just came tanking down, and then I guess they did some kind of reverse split in there. And the stock today, actually just today, is up 58%. They gapped up this morning. They're up about $6 to $17. And, they just last week, they hit a low of $6. So everybody's trying to jump on this trade because the company has done some things with its cash flow that seem to be working for them. I still think that they have some cash issues and some notes that are coming due, but Everybody seems to be jumping in on them, A, because they're cheap, and I don't recommend buying cheap stocks if you can help it. This was a penny stock, just last week, penny stock being something around $5 or under. But everybody was jumping out of this. The volume was increasing, and now the volume is changing the personality on it, and people are trying to jump in this stock. Now, I wouldn't recommend. Now, it did have a couple things that went for it. Number one is it did a reversal off the bottom on high volume. That's a big indicator that the stock has stopped going down, and at least it's going to either go sideways or up. Then this week, it confirmed the bounce on good volume so far, and it gapped up. Those are a couple of good things on the short term that look like a bottom could be in place. However, when a stock has this kind of a decline from, let's call it 120 almost straight down to 6, all those people that bought at 120 and have been holding it, they're all saying it'll come back, it'll come back. And if it comes back a little bit, some of them are starting to say, you know what? The ones that bought it at 20 on the way down, when it gets back up to 20, they're going to sell. Because they're sitting there going, oh, if it'll only get back to my break even. Psychologically, that's what most of us do because we don't want to be wrong. So when it gets back to my break even, I'll sell. So the higher it goes, the more sellers there are that don't want to look wrong. So that's called overhead supply. People that are waiting in the wings to be able to sell the stock. So this has a major battle to fight, as they all do actually, a major battle to fight as it builds the right side of this base. And there's a lot of sellers there that are not going to let it build a very big, strong base. So I'd expect this stock to probably start to make a bottoming pattern in here, anywhere between a range of $6 and $18. It'll probably start to go back and forth based on the action that I'm seeing today. Could go higher, could go lower, but usually you won't see a V-based recovery or a straight-up recovery because of all that overhead supply. That's what we're seeing right now.
Yeah, and I want to reiterate what you described earlier in the conversation is this stock went down about 80 or 90 or more percent from its top to its bottom. Now, in the last week, it went up about 300%. Yeah. It still has to go up 600 or 700 more percent from today's new high of the week to get back to that original even breaking point for people who bought it at the peak, right? And that's nearly unheard of, right? I mean, has a stock, have there been histories of stocks that went down 80 or 90% and came back to their original peak? Yeah, there were a lot of stocks in the 2008 period that went way down. Bank of America going way, way, way down. I think it was under $3 or maybe even $1 at that point. I can't remember the exact price, but now it's at 20 something dollars, and it was at 30 just a couple of months ago. So yeah, they can. That took about a decade. Yeah, it took a long time. You got to be patient, and that's dead money. That's money you're waiting that you're not putting to use in your other investments. And one of my mentors, Bill O'Neill, says if you're not making 40% in the stock market, you're not doing something right. And he's right, because we do fairly well. And if you have a strategy for protecting yourself on the downside, and you have a strategy for risk management on the upside, like adding value as the value increases, adding your position, then that's how you start to multiply just a stock that goes up a little bit, let alone one that needs to go up, 3 or 4 or 500% for you to even get back a portion of the amount you lose. So these FOMO trades are very interesting. This fear of missing out, people are seeing it go up 300% in the last 2 weeks. They're like, oh, I knew it. I knew I should have bought that cannabis company. Well, yeah, but you didn't hold it from 150 to 6. You're just seeing it now at 6, thinking, oh, if I just picked the bottom, which very few people can actually pick the bottom, and held it to 18, I would have made 300%. Just very difficult to find the timing on that. Now, conversely, I don't want to be all doom and gloom on those trades. If you believe in this, a company like Aurora, and you think they're doing some good things, and you buy it at 16, let's say, and it goes to 20, well, you made 25% or whatever it is, right? Yep. On your stock. That's still a good trade on its own, not worrying about the previous chart or the previous graph, right? Or the ski slope, if you will. That's still a fine trade to go from 16 to 20. You made a nice percentage on your return, and then you decide what you want to do with it. So there are different ways to play these stocks in the interim and not worry about the long jaded history it may have. Yeah, you have to view the present in the shadow of the past, because the past is telling, like I told, that overhead supply, there's sellers there. Now, maybe they're not showing their colors yet, but at some point they're going to want to sell. They've been waiting for, almost 2 years for the stock to get back to even. At some point they're going to say, I've waited. I don't know if maybe now is my opportunity to get out.
So you've got to be an expert at picking the bottom or the best probability for the stock to go from 16 to 20. It could easily happen and it could go to 40, who knows? But the probabilities are against you when you have this kind of precipitous decline. If you study the thousands and tens of thousands of charts that I've studied, you just don't see it where it goes straight back up and everybody's happy, right?
Right. And to give another point of view, a stock that had a reverse split, this stock just went from 6 to 18 in the last week or last few days. It really only went from 50 cents to $1.50.
That's right.
You know what I mean? From 2 weeks ago. So
yeah.
you have to kind of do your own research and figure out what's really happening, not what it looks like might be happening. All right, enough on Aurora. Mark, give us another one you looked at and tell us a little story on that.
Well, let me shift to a slightly different story, and that is a company called Innovative Industrial Properties. And this is one that you actually pointed out to me, Lenny, and it's an interesting one in that it looks totally different from a chart perspective than any of the other ones in this sector. And the reason I'm saying that is if you can imagine a chart in front of you, you want to be buying charts that go from lower left corner to the upper right corner. And by and large, IIPR, which is the symbol of this, Innovative, is showing kind of a chart like that. Now it's still in a short-term downtrend, but by and large, this chart is moving that way. And here's why: it pays a yield. So this is a real estate play more than a cannabis play. They got a couple 100,000 square feet of industrial space here and there. They're a real estate investment trust, and the way the laws in this country are set up is that 90% of all profits have to be paid out to the investors in a real estate investment trust. So if you were to buy this stock today, you'd be getting a 4.6% yield while you wait for it to go up. Of course, it could go down, and then that's even worse. You don't buy a stock for a yield, and if it goes down, you're hoping that it's great. So the reason this stock probably performs better is because it's a real estate play and it's going to be paying some kind of a dividend, some kind of a yield while we wait for this crazy market to come back, while we wait for the cannabis market to come back, while we wait for the feds to legalize things. This stock is certainly trying to make a short-term bottom in an uptrend, a longer-term cyclical uptrend. So it's interesting in that it's not a cannabis play. It's a cannabis play via real estate. They buy warehouses where they store cannabis and they grow cannabis and things like that. So it's a real estate play.
Yeah, that acts as a real estate investment trust type security, right. Correct?
Yep, exactly.
Excellent. Okay, what else you got?
All right, so I've got Cronos, which this chart looks like the one we just talked about, that Aurora, and even looks a little bit like Canopy. But again, this is a big sell-off from what I'm showing on my chart to about 25 at the end of 18. To, it went down and hit 4. So if you had owned this from 25 to 4, you'd have lost an awful lot of money the whole time waiting for this thing to make a rounding bottom so that it can come back up. That being said, it had a good bottoming pattern about 2.5 months ago. Not a high volume spike off the bottom, but it looks like it made a fairly solid bottom. Now it's trying to make a process going back and forth between, say, 4 and 6, making a base. If it can hold that base and not go back down and test those lows, it's going to make some cause for going higher. The thing I don't like about really any of these stocks is they don't make money. So if they have to keep waiting and waiting and waiting and waiting for these markets to come back, for the environment to set up for them, if they don't have a lot of cash, if they're highly in debt, they may not be able to hang on. So that's the thing I don't like about them, is they lose a lot of money, except for that Innovative Properties that we talked about, because they make money per share. This one here, Cronos, is a stock that, in 2019 made 333, but it's sandwiched by years that are losing years. So not the end of the world, doesn't have a lot of debt from what I see, but it's going to be making a bottoming pattern, and it's going to be a while in this bottoming pattern for it to come back up, is what I see.
Got it.
I've got another one here, Tilray. So Tilray, similar story, went from about
TLRY, and that had a huge spike in the beginning.
Oh my God,
gigantic.
Sure did. This one IPO'd at 20-ish, and then it shot straight up to 300 in a matter of like 5 weeks. So if you bought that, you were a genius, right? If you held it, you were the opposite of a genius, because it went from 300 down to 3. Okay, so it's lost what?
It's almost like it's make believe, like it's made up, right? Like what an amazing. That's a ridiculous spread. Ridiculous.
Yeah, And, I have a rule. I sell 7% below a proper buy point because probabilities just show that stocks that go down to 7% keep going down. So, I would have gotten out fairly early. Hopefully, it's hindsight, it's obviously, I certainly would have gotten out. And anybody who owns it that didn't get out wishes they would have gotten out. But if you held it, man, you lost like 99% of your investment. It's made a bottoming pattern here about 2 months ago, around the same time some of the other ones did. And this one did it on very good volume. So I'd be very surprised if it ever sees 3 again. But I think you're going to bounce around between, say, 6 and 8 for a while until some of the trends start to turn up. But, this one here, again, losing money. So in 2018, they lost 68 cents a share. 2019, $1.70 a share they lost. It keeps increasing to $2.39 in 2020. Looks like they start to turn it around, hopefully next year. It's a long time to wait for a company to become profitable. This is almost like one of those drug development companies that, is never profitable until they get their drug approved by the FDA, which is probably a good analogy for this whole sector. The only issue I have with Tilray is they have a lot of debt. And I don't know what the terms of that debt are, but 156% of their company is debt. That's a lot. And so if they don't have the cash coming in to be able to cover the debt, that creates a problem for the long-term viability, which is why the stock probably went from 300 to 3.
Yeah. And I just want to put a disclaimer out there. Neither Mark nor myself are telling you to buy any of these stocks. This is merely an informational discussion and episode of our show. So you have to do your own research and figure out what's best for you. So that being said, Mark, tell everybody where they can find more information about you or what you have been going on with Hacking Money.
Well, I believe in never giving up your power and your health, your wealth, or your time. So if you go to the doctor and he tells you have 6 months to live, if you believe him, that's probably true. You have 6 months to live. But if you start to take your power back in your health and you start to figure out alternatives, maybe you have a better chance because it's not just one opinion that you're giving up your power to. The same thing happens in wealth. And so if you're out there listening to this, people in your audience, Lenny, are, probably people that are trying to do their best, but you're out there doing your job, your thing that you're so good at doing, your genius, right? And so you make this money and then you give it over to somebody else. The problem is you give up your power in it. So the reason we're spending the time going over all these charts is not so that I can tell you what to buy. It's so that you can tell you what to buy. It's so that you can take the power back and start to look at charts in a different way. And instead of giving up your power and having somebody tell you what to buy and sell, you decide where to buy and sell. Have a strategy, have a risk management position. So my goal in all these things is to teach people to fish, right? It's not to give them the fish. I want people to learn the things that I know. So we create courses, we create environments where people can learn and things like that. So you asked me for a plug, I'll give you a plug. It's hackingmoney.com. If you're interested in watching a free webinar that I put together, go to hackingmoney.com, put a / in there and put the word registration after that. That'll take you to a link for a master course that we have. It's free. It gives you a bunch of good content. And then I make you an offer at the end that if you want to get involved with us a little bit more, that's great too. But my main thing is to teach people the really cool stuff about not just money and investing and starting and debt and saving and all that, but really some nuances about the markets out there and how you can take advantage of them. Because there are some really easy ways to make 8% if you're an income investor. We have strategies for that. There's some really easy ways, and I say easy, I would say easier than what's out there for you to make aggressive plays to make 40% by capitalizing on some of these trends. Now imagine if you shorted the stock at 300 and wrote it down to 3 instead of buying it at 300 and writing it down to 3. Yet it's a different story, right? Most people don't know anything about how to short a stock, how to ride a downtrend. So there's ways to make money on the way down and ways to make money on the way up and ways to manage your risk in between that period of time. And all we want to do is get the word out and let people know that Wall Street has these secrets. Why shouldn't you?
That's fantastic. Well said. Very, very good. Thank you, Mark. And before I let you go, we're going to hit you with one last question. So we talked about the cannabis stocks, obviously, and thank you for doing that. Let's give everybody a little tidbit on what they're seeing in the general market right now on the charts. So we had, in the beginning of 2020, after the pandemic started hitting, boom, the market tanked. And now it's had a little run up back to respectability over the last month or so, however you want to term it. What is that looking like on the charts for any future probability?
Yeah, so the market did have a spike down, let's call it 30%. Depends on what stock you own, because it could have been a lot more than 30%. But just generally on average, most of the major indices went down 30%. They've had about a 50% increase back, so you've only lost 30%. And now what's going on, and this is a several week, maybe a several month bottoming pattern going on, it's up about 50% off the lows. And now you're seeing it trying to make a base in there. And so this has now it's gone from kind of a buy and hold market, which is what everybody said was the only way to invest over the last several years, to a stock pickers market. So you kind of have to know what you're doing, what you're looking for. There are lots of opportunities out there, but if you muddle your opportunities with the averages, you're probably just going to be average, and you're probably going to sit there and have dead money for maybe a year or two while this market bottoms. So all the pundits are saying that the market's going to go hit new highs by the end of the year, or a lot of them are. But fundamentally for me, with all these businesses shut down, with a whole quarter of numbers missing, I don't see an accelerant in getting the market back up to those highs. Just doesn't make sense that it would be back up to the highs, other than the fact that the Fed is printing money with abandon. And so you never fight the Fed. If the Fed is pumping all this money in, the money's going somewhere. And in theory, it's going into the markets. I don't know how much longer that will sustain, but that certainly, I think, is a big story for why the bounce has come back 15%. So what we're doing is kind of expect a bottoming process here, where there's a range-bound trade for the next, I don't know, maybe 6 months. I can obviously be proven wrong. I try to not make predictions, but this is just how I see it. Fundamentally and technically, I don't see we're gonna have much more downside or much more upside. We're just going to be kind of range bound within a range here for the next few weeks or months.
And that time frame coincides with a presidential election. So not caring what side anyone is on, how does an election result either way usually affect the market in a normal time? I know we're not in normal times right now, but how does that usually affect?
Anything but normal right now. But generally, a presidential election does have some effect. It's generally discounted before the election, although last time it really wasn't. So last time in 2016, the odds makers were all saying that it was going to be a Democrat. And when that didn't turn out to be the case, the market went up with abandon at that point, went up incredibly from that point. So the market generally likes conservative administrations because they're generally fiscally stimulative. And so they'll cut rates, they'll cut taxes, and they'll put money back into the economy so that there's high velocity and lots of circulation of money. And when money circulates, economies grow. And that's kind of proven to be true since 2016 until this virus hit. So depending on who wins, that probably will be the continual trend. If the conservative side ends up winning, you'll probably see more spikes up. If the other side wins, I don't know. The markets traditionally have shown that they don't love that action, and they are muted in their response, generally going down, but certainly not going up as much.
Mark Yegge, founder of hackingmoney.com, successful hedge fund manager. Thank you so much for taking the time today.
Thanks, Lenny, and thank you for all your listeners.
All right. I'll see you soon, my friend, and we'll see everyone next time on the Pot.Live podcast. If you are into the recreational side of the cannabis industry, yes, stoners, I'm talking to you, then thepot.com is the online and mobile destination for you. That's right, THEPOT.com, thepot.com. Where else can you find the exclusive Pot Mate of the Month? Take a pot quiz and win prizes. Scroll through hilarious memes and jokes and check out the latest podcasts, news, and trends, all while having your own profile and voice in the pot.com forum. Visit thepot.com today and get lit.